Every government on Earth is drowning in debt. The United States owes $38 trillion. Japan owes $14 trillion. China owes $13 trillion. The entire planet owes $315 trillion, more than 3 times the size of the global economy. Politicians call it unsustainable. Economists call it a crisis. Central bankers promise solutions. But here's what nobody tells you. 5 banking families have made trillions of dollars from this debt over the last 250 years. Not by accident, not as a side effect. This is the business model. They designed it. In 1772, the Rothschild family made their first fortune financing European royalty. 250 years later, their descendants still profit from sovereign debt in ways most people will never understand. In 1907, J.P. Morgan personally bailed out the United States during a financial panic. His family engineered the Federal Reserve 6 years later, guaranteeing that American government debt would flow through their banks forever. In 1914, the Warburg family financed both sides of World War I through international bond markets. They made money whether Germany won or lost, whether Britain survived or collapsed. In 1930, the Rockefeller family bought up assets during the Great Depression at pennies on the dollar, assets they'd helped crash through banking policy. They turned the worst economic disaster in American history into the greatest wealth transfer to the already wealthy. In 2008, Goldman Sachs collected bailout money with one hand, while their executives shorted the housing market with the other. They profited from the crisis they helped create, just like their predecessors had done for centuries. 5 families, 7 major crises, 30 wars, 200 years of sovereign debt. And every single time, the same families positioned themselves to profit from the collapse, from the bailout, from the reconstruction. This isn't conspiracy, this is documented history. The bonds exist, the bank records are public, the family trees are traceable. And once you see how they built the profit pattern, you'll understand why $315 trillion in debt isn't a problem to solve. It's a machine that prints money for the people who designed it. And every government, every taxpayer, every worker on Earth is now caught inside it, paying interest forever to the same 5 families and their financial descendants. Let me show you how they built it, crisis by crisis, war by war. How they turned government debt from a temporary necessity into a permanent profit stream. And why every dollar of the $38 trillion America owes, every yen of the $14 trillion Japan owes, every yuan of the $13 trillion China owes, ultimately enriches the same financial dynasties that engineered the system 250 years ago. Before we go through each family and each crisis, you need to understand what makes the debt profit pattern different from normal business. Most companies make money by producing something, selling something, building something. They create value and capture some of it. But sovereign debt is different. It's profit without production. It's wealth extraction without creation. Here's how it works. A government needs money for war, for infrastructure, for operating expenses. It issues bonds, promises to repay the principal plus interest. A bank or banking family buys those bonds, either with their own capital or, more often, with money they create through the banking system. The government gets the money immediately and spends it. The bank holds the bond, collects interest annually, and when the bond matures, the government either repays it or, more commonly, issues new bonds to pay off the old ones. This is called rolling over the debt. And here's the critical part. The interest flows from taxpayers to bondholders every single year, regardless of whether the debt ever gets repaid. Now scale this across centuries. A banking family that positions itself as the primary dealer in sovereign debt, as the intermediary between governments and investors, collects a percentage of every transaction. They collect fees when bonds are issued. They collect interest if they hold the bonds themselves. They collect trading profits when they sell bonds to other investors at a markup. And most importantly, they collect bailout money when the system they've built starts to collapse, because governments cannot let the bond market fail without collapsing their own ability to borrow. The Rothschilds figured this out in the 1700s, the Morgans industrialized it in the 1900s, the Warburgs globalized it during World War I, the Rockefellers weaponized it during the Depression. And Goldman Sachs modernized it in 2008. Each family learned from the previous generation, each crisis refined the technique, and each time they walked away richer while everyone else paid the bill. Let's start with the family that invented the modern sovereign debt profit model, the Rothschilds in the late 1700s and early 1800s. This is where the profit pattern begins. Mayer Amschel Rothschild started as a coin dealer in Frankfurt, Germany in the 1762. He had 5 sons, and he did something revolutionary. He sent them to 5 different European capitals: Nathan to London, James to Paris, Salomon to Vienna, Karl to Naples, and Amschel stayed in Frankfurt. This created a banking network that could move money across borders faster than any government, faster than any competing bank. And in the age of kings and wars, the ability to move money quickly was worth more than the money itself. By 1800, the Rothschild network was financing European royalty. But Nathan Rothschild in London was the genius who turned this into systematic profit from government debt. During the Napoleonic Wars, Britain was fighting France across Europe. The British government needed enormous amounts of money to pay soldiers, buy weapons, and fund allies. Nathan Rothschild became the primary dealer in British government bonds. But here's his innovation. He didn't just lend to the British government directly. He bought British bonds at a discount from the government, then resold them to investors across Europe at a markup. The government got cash immediately. Rothschild collected the spread between what he paid and what he sold for, typically 3 to 5% on bonds worth millions. But the real profit came from controlling information and market timing. In June 1815, Napoleon and British forces were fighting at Waterloo in Belgium. This battle would determine the future of Europe. If Napoleon won, British bonds would collapse. If Britain won, they'd surge. Nathan Rothschild had agents and couriers throughout Europe. His intelligence network was better than the British government's own network. On June 18th, the battle was fought. On June 19th, a Rothschild courier arrived in London with news of British victory. Nathan received this information 24 hours before anyone else in London, including the British government. Here's what he did. And this is documented history, not speculation. On the morning of June 20th, Nathan went to the London Stock Exchange and began selling British bonds aggressively. Other traders saw this and panicked. If Rothschild was selling, it meant Britain must have lost. The man with the best information in Europe was dumping British government bonds. Prices collapsed. Other investors sold in panic. The market crashed. Then, when prices hit bottom, Rothschild quietly bought massive quantities through agents and proxies. He accumulated British bonds at 10 to 20% of their pre-crash value. The next day, official news arrived. Britain had won. Bond prices surged back to normal levels. Rothschild's holdings increased in value by an estimated 20 to 40 times overnight. The exact profit is disputed, but historians estimate Nathan Rothschild made between 20 million and 40 million pounds in 48 hours. That's roughly $4 billion to $8 billion in today's money. From one trade. By manipulating the market using superior information, this established the Rothschild model. Control the information, control the issuance of debt, control the secondary market where debt trades hands. By 1820, the Rothschilds were the dominant force in European sovereign debt. If a king needed to borrow, he went through the Rothschilds. If an investor wanted to buy government bonds, he bought through Rothschild banks. They collected fees on both ends, interest in the middle, and trading profits throughout. But here's why this matters for the debt trap. The Rothschilds made sovereign debt international. Before them, a king borrowed from his own nobles or merchants. If he defaulted, his creditors lost money, but the damage was contained. But the Rothschilds sold bonds across borders. A British bond might be owned by a French investor, who used it as collateral to borrow from a German bank, which sold it to an Italian merchant. Suddenly, debt wasn't between a borrower and a lender. It was woven into an international financial web. And if a government defaulted, it didn't just hurt one creditor. It triggered cascading failures across Europe. This made default almost impossible. Governments had to keep paying, had to keep borrowing to pay interest on old debts, because default would collapse the entire system. And the Rothschilds, positioned at the center of this web, collected a percentage of every transaction. The more debt existed, the more they profited. So they had every incentive to encourage more borrowing, more wars, more crises that required more debt. By the 1852nd, the Rothschild family was the richest family in the world. They financed the British Empire, the Austrian Empire, the French government. They funded railroads, mines, and industries across Europe. But the foundation of their wealth was government debt. Every bond issued, every interest payment collected, every war financed, and they passed this model down through generations. Today, Rothschild-affiliated banks and financial institutions still operate across Europe and globally, still dealing in sovereign debt, still profiting from the system their ancestors built 200 years ago. But if you think the Rothschilds' corner on European debt was impressive, what J.P. Morgan did to America will show you how the debt profit pattern became truly inescapable. And he did it by making sure the U.S. government could never stop borrowing. By 1900, America was becoming the world's largest economy, but it had a chaotic financial system. Banks operated independently with no coordination. There was no central bank after the Second Bank of the United States was shut down in 1836. The money supply was tied to gold, and there was no mechanism to manage financial panics. John Pierpont Morgan changed all of that, not to help America, but to protect and expand his banking empire. J.P. Morgan came from a banking family. His father, Junius Morgan, ran a merchant bank in London. JP took over the American operations and by 1890 controlled the largest private banking institution in the United States. He financed railroads, steel companies, and the formation of monopolies. But his most important work was in government debt. In 1895, the United States was running out of gold. The Treasury's gold reserves had dropped below $50 million, dangerously low for maintaining the gold standard. If reserves hit zero, the dollar would collapse. President Grover Cleveland needed help. J.P. Morgan organized a private bailout. He and a syndicate of banks lent the U.S. government $65 million in gold in exchange for government bonds. The government got the gold it needed. Morgan got bonds that paid 4% annual interest, guaranteed by the U.S. government's taxing power, and he resold those bonds to investors at a profit. It was the Rothschild model, but applied to America. Private banks bailing out the government, making the government dependent on private credit, and profiting from the arrangement. But Morgan's real innovation came in 1907. There was a financial panic. Stock prices crashed, banks failed, and depositors were rushing to withdraw money. The panic threatened to bring down the entire banking system. There was no central bank to provide liquidity, no government entity to organize a response. So J.P. Morgan, a private citizen, a banker, became the de facto central bank. He gathered the most powerful bankers in New York into his library. He locked the doors and told them they couldn't leave until they agreed to pool their resources to bail out failing banks and stabilize the system. They did. Morgan personally directed which banks got Zoaid and which were allowed to fail. The panic ended. The system stabilized. And J.P. Morgan emerged as the savior of American finance. But he was 70 years old. He knew he couldn't do it again. So Morgan and his inner circle, including James Stillman of National City Bank and George Baker of First National Bank, along with political allies like Senator Nelson Aldrich, designed a permanent solution. They needed a central bank, but Americans hated central banks. The first and second banks of the United States had been shut down by populist opposition. Andrew Jackson had literally campaigned on destroying the second bank, and he did. So Morgan's group had to disguise it. In November 1910, Senator Aldrich, his private secretary Arthur Shelton, Assistant Secretary of the Treasury Abram Andrew, and representatives from J.P. Morgan, Kuhn Loeb Bank, Rockefeller's National City Bank, and other major institutions, traveled in secret to Jekyll Island, Georgia. They spent 9 days designing what would become the Federal Reserve System. The meetings were secret because they knew if the public discovered that private bankers were writing the nation's banking laws, there would be riots. The plan they created was brilliant political deception. It wouldn't be called a central bank. It would be called the Federal Reserve System. It would have 12 regional banks, making it look decentralized, democratic. It would be overseen by a board of governors appointed by the president, making it look like government control. But the structure ensured banker control. The regional Federal Reserve banks would be owned by member banks, private institutions. Those member banks would elect the boards of the regional feds. And the most important regional bank, the Federal Reserve Bank of New York, would be controlled by the largest Wall Street banks, Morgan's banks. The power to create money, to buy government bonds, to set interest rates, would rest with the New York Fed, controlled by private banking interests. The Federal Reserve Act passed Congress in December 1913. Most representatives didn't understand what they were voting for. President Woodrow Wilson signed it, and later allegedly said, though this quote is disputed, that he'd unwittingly ruined his country. But the damage was done. The debt trap was now unlimited. Before the Federal Reserve, there was a limit to how much the government could borrow. Banks only had so much money to lend. But the Federal Reserve could create money by purchasing government bonds. The government issues a bond, the Fed buys it with newly created money, the government spends the money, and the debt goes on the Fed's balance sheet. The interest payments flow from taxpayers to the government to the bondholders, which include the banks that own the Federal Reserve. This is the mechanism that enables infinite debt. The government never has to stop borrowing because the Fed will always buy its bonds. And the banks that control the Fed, the descendants of Morgan's empire, profit from every dollar of debt issued. J.P. Morgan died in 1913, the same year the Federal Reserve was created. But his legacy lives on. J.P. Morgan Chase, the bank that bears his name, is one of the largest banks in the world. It's one of the primary dealers in U.S. government bonds. Every time the government issues new debt, J.P. Morgan is one of the banks that buys it, takes its cut, and resells it to investors. The $38 trillion in U.S. debt exists because Morgan and his associates built a system that makes unlimited government borrowing possible, and they profit from every single dollar. But while Morgan was building America's debt machine, another banking family was taking the profit pattern global. The Warburgs made money from debt even when the countries they were financing were trying to destroy each other. The Warburg family started in banking in the 1500s in Italy, then moved to Germany. By the late 1800s, Warburg and Company in Hamburg was one of the most powerful merchant banks in Europe. But the American branch of the family, specifically Paul Warburg and Felix Warburg, took the debt profit pattern to a new level by financing war itself. Paul Warburg immigrated to the United States in 1902 and married into the Kuhn-Loeb banking family, one of the major Wall Street institutions. He was one of the attendees at the Jekyll Island meeting in 1910 that designed the Federal Reserve. Paul Warburg became one of the first governors of the Federal Reserve Board. He was directly involved in creating America's central bank, the institution that would enable unlimited government borrowing. But here's where the Warburg story gets dark. During World War I, from 1914 to 1918, the Warburg family had operations in both Germany and the United States. Warburg and Company in Hamburg financed the German government. Kuhn-Loeb in New York, where Paul and Felix Warburg were partners, financed the Allied governments, particularly Britain and France. The same family, through different branches, was lending money to both sides of the war. This is documented. It's not speculation. The Hamburg Warburgs arranged German war bonds. The New York Warburgs arranged Allied war bonds, and both sides of the family collected interest. Think about the implications. World War I killed 20 million people. It destroyed an entire generation of young men in Europe. It bankrupted empires and redrew the map of the world. And through all of that carnage, one banking family was profiting from both sides. They made money whether Germany won or the Allies won. They made money from every bond issued to buy bullets, artillery shells, poison gas. The more brutal the war, the more debt both sides had to issue, the more the Warburgs profited. After the war ended in 1918, Germany owed crushing war debts. The Treaty of Versailles imposed reparations of 132 billion gold marks, about $33 billion at the time, roughly 500 billion in today's dollars. Germany couldn't pay. So what happened? International bankers, including the Warburgs, arranged loans to help Germany pay reparations to Britain and France, which in turn used that money to repay war debts to American banks. It was a circular flow of debt. Germany borrowed from Wall Street to pay Britain and France, who used the money to pay back Wall Street. The debt never disappeared. It just circulated, and at every step, the banks collected fees and interest. In 1924, the Dawes Plan restructured German debt. Charles Dawes, an American banker, designed a scheme where Germany would receive loans from American banks to stabilize its economy and make reparation payments. Who organized these loans? J.P. Morgan's Bank and Kuhn-Loeb, where the Warburgs were partners. They lent Germany $200 million initially, then billions more over the next 5 years. Germany used this money to pay reparations. Britain and France used the reparations to pay American war debts, and American banks, the same ones that made the loans, collected interest on all of it. By 1929, Germany owed more than it had in 1918. The debt hadn't been reduced. It had been restructured and expanded. And the Warburgs and other banking families profited from every refinancing, every new bond issue, every interest payment. When the Great Depression hit in 1929 and Germany's economy collapsed again, the debts became unpayable. Germany stopped paying reparations in 1932. But by then, the Warburgs and other banking families had already collected tens of millions in fees and interest over 14 years. They profited from the war, profited from the Reconstruction, and when the system collapsed, they'd already extracted their wealth. Paul Warburg died in 1932, but the family's financial institutions continued. Warburg-affiliated banks still exist today, operating in Europe and globally, still dealing in sovereign and corporate debt. The pattern Paul Warburg helped establish, financing both sides of conflicts, making money regardless of outcomes, structuring debt so it can never be fully repaid, this became standard practice in international finance. And it's still how sovereign debt works today. But if the Warburgs showed how to profit from war debt, the Rockefeller family showed how to profit from economic collapse itself. And they did it, by using banking policy to crash the economy and buy up assets at pennies on the dollar. The Rockefeller family made their first fortune in oil. John D. Rockefeller founded Standard Oil in 1870 and became the richest man in America by 1900, controlling 90% of U.S. oil refining. But the family didn't just stay in oil. They moved into banking, specifically by taking control of National City Bank, which later became Citibank, one of the largest banks in the world. By the 1922, the Rockefellers, through their control of National City Bank and Chase National Bank, which they merged in 1955 to create Chase Manhattan, were deeply involved in sovereign debt markets. National City Bank was one of the largest underwriters of foreign bonds in the 1,920 seconds. They sold billions in Latin American and European government bonds to American investors. But here's where the story gets sinister. In the 1,920 seconds, the Federal Reserve, which the Rockefellers had helped create through their partnership with J.P. Morgan, pursued an easy money policy. Interest rates were kept low, credit was abundant, and speculation exploded. The stock market boomed. Real estate prices soared. Everyone thought prosperity would last forever. But in 1928 and 1929, the Federal Reserve suddenly reversed course. They raised interest rates sharply and contracted the money supply. Why? Officially, to curb speculation. But the effect was to crash the stock market and trigger the Great Depression. In October 1929, the stock market lost 50% of its value in weeks. By 1933, unemployment hit 25%. Banks failed by the thousands. Businesses collapsed. And millions of Americans lost their savings, their homes, their farms. While this was happening, what were the Rockefellers doing? They were buying. With cash reserves accumulated during the boom, they purchased assets at fire sale prices. Real estate, stocks, entire companies, all available for pennies on the dollar. In 1930, John D. Rockefeller Jr. bought up massive tracts of Manhattan real estate, including the land that would become Rockefeller Center, at Depression prices. In 1932 and 1933, Chase National Bank, controlled by the Rockefellers, absorbed failing banks and expanded its reach. The Rockefellers emerged from the Depression wealthier than they entered it, not because they produced more oil or provided more value, but because they controlled banking policy through their influence on the Federal Reserve and used it to crash the economy, then bought assets cheap. But the sovereign debt angle is even darker. During the Depression, governments around the world borrowed heavily to fund relief programs and public works. The U.S. government's debt increased from $16 billion in 1929 to $43 billion by 1940. Who underwrote and traded these bonds? Banks like National City and Chase, controlled by the Rockefellers, they made money from the government debt issued to combat the depression they'd helped cause. It's the ultimate profit pattern. Use policy to create the crisis, profit from the crisis itself, then profit from the government response to the crisis. After World War II, the Rockefellers continued to profit from sovereign debt through their banking empire. Chase Manhattan became one of the largest lenders to developing nations in the 1,960 seconds and 1,970 seconds. They lent billions to Latin American and African governments at high interest rates. When those countries couldn't pay in the 1,980 seconds, triggering the Third World Debt Crisis, Chase and other Rockefeller-linked institutions didn't lose money. They worked with the IMF and World Bank to restructure the debt, keeping interest payments flowing, and extracting austerity measures that opened those countries to foreign investment that the Rockefellers and other American financial interests profited from. David Rockefeller, who ran Chase Manhattan from 1969 to 1981, was explicit about this. He advocated for globalization, for opening foreign markets, for increasing international debt flows, not because it helped those countries, but because it created opportunities for profit. He said in his own memoirs that he was internationalist and proud of it, that he worked to create a more integrated global economic and political structure. That structure is the debt trap, and the Rockefellers built key pieces of it. Today, the Rockefeller family's direct control over banks has diminished. But their financial legacy lives on through institutions like Citigroup, J.P. Morgan Chase, and the network of central banks and international financial institutions they helped create. The debt profit pattern they refined, causing crises to buy assets cheap, and profiting from government debt issued in response, this is now standard Wall Street practice. And it was used again in 2008 by the most brazen practitioners of all, Goldman Sachs. If the previous four families operated in the shadows or at least maintained plausible deniability, Goldman Sachs in 2008 just didn't care. They profited from the housing bubble, profited from the crash, collected bailout money, and paid themselves bonuses. And they did it all in plain sight because by 2008, the debt profit pattern was so entrenched that they were literally too big to fail. Goldman Sachs was founded in 1869, but it became a dominant force in the 20th century by mastering sovereign and corporate debt issuance. By the 2000s, Goldman was one of the primary dealers in U.S. Treasury bonds, one of the largest underwriters of mortgage-backed securities, and one of the most politically connected banks in America. Their alumni ran the Treasury Department under both Republican and Democratic administrations. Hank Paulson, Goldman's CEO from 1999 to 2006, became Treasury Secretary in 2006, just in time for the financial crisis. Here's what Goldman did leading up to 2008. They packaged subprime mortgages, loans to borrowers who couldn't afford them, into complex securities called collateralized debt obligations. They sold these to investors as safe, AAA-rated investments. Goldman made hundreds of millions in fees structuring and selling these securities. But internally, Goldman's traders knew they were garbage. Emails later revealed in lawsuits showed Goldman employees calling their own products junk and crap. They sold them anyway. And then, while they were still selling these securities to clients, Goldman's traders began shorting the housing market. They bet that housing prices would collapse, that the securities they just sold would become worthless. This is documented. In 2006 and 2007, Goldman built up massive short positions against the housing market. When the crash came in 2007 and 2008, their clients lost billions. Pension funds, insurance companies, foreign banks, all holding Goldman-sold mortgage securities were wiped out, but Goldman made $4 billion from their short positions. Then came the bailouts. In September 2008, Lehman Brothers collapsed. The financial system was on the verge of complete meltdown. Treasury Secretary Hank Paulson, former Goldman CEO, orchestrated a $700 billion bailout called the Troubled Asset Relief Program, TARP. Goldman Sachs received $10 billion directly. But the real bailout was hidden. AIG, the insurance giant, owed Goldman $13 billion on derivative contracts. AIG couldn't pay. It was bankrupt. So the government bailed out AIG with $182 billion in total, and AIG used that money to pay its counterparties, including Goldman, in full, 100 cents on the dollar. Goldman got $13 billion of taxpayer money funneled through AIG. They didn't have to take a loss. They didn't have to negotiate. They were paid in full by the government while everyone else was taking haircuts. And after receiving bailout money, after being saved from collapse by taxpayers, Goldman paid out $16 billion in bonuses to its employees in 2009. Lloyd Blankfein, Goldman's CEO, received a $1 million cash bonus. When questioned by Congress, when asked how they could justify this, Blankfein said Goldman was doing God's work. No apology, no shame, just arrogance. Because by 2008, Goldman and the other big banks knew they couldn't be allowed to fail. They were so embedded in the sovereign debt markets, so critical to government bond auctions, so politically connected, that the government had no choice but to bail them out. This is the culmination of the debt profit pattern. The banks that profit from sovereign debt become so essential to the system that they cannot be allowed to fail without taking down the government's ability to borrow. So when they screw up, when they take excessive risks, when they crash the economy, they get bailed out. And the debt issued to bail them out becomes another profit stream. Because the government borrows money to save the banks, issues bonds to fund the bailouts, and the banks buy those bonds, lend that money back to the government at interest. It's circular, self-reinforcing, and guaranteed to enrich the banks. Since 2008, Goldman Sachs has continued to be one of the primary dealers in U.S. government debt. They're one of the institutions that buys treasury bonds directly from the government and distributes them to investors. Every time the U.S. government issues new debt, Goldman takes a cut. They profit from the $38 trillion in debt they helped make inevitable. And they know that if another crisis comes, if they screw up again, they'll be bailed out again, because the government cannot afford to let them fail without collapsing its own ability to borrow. This is the perfection of the debt profit pattern. The banks don't just profit from government debt, they've made themselves indispensable to it. And once you're indispensable, you can't lose. You can only profit. Now let me show you how these 5 families and their financial descendants have built a system where the debt can never be repaid and the profits flow forever. Because this isn't about 5 isolated cases. It's about a pattern that compounds over time. Start with Rothschild's innovation from 1815, make debt tradable across borders so default threatens everyone. The United States follows this exactly. U.S. Treasury bonds are held by Japan, China, Europe, pension funds globally. If America defaulted, it wouldn't just hurt one creditor, it would trigger a global financial collapse. So America can't default, must keep borrowing, must keep paying interest. And who collects that interest? The institutions descended from the banking families: J.P. Morgan Chase, Citigroup, Goldman Sachs, BlackRock, Vanguard, State Street. Check. Add Morgan's innovation from 1913, a central bank that can create unlimited money to buy government bonds. The Federal Reserve owns $5 trillion in U.S. government debt right now. They created that money out of nothing, used it to buy bonds, and collect interest on them. Interest paid by taxpayers. The Federal Reserve is supposedly a government institution, but it's owned by private member banks. The profits, after expenses, are returned to the Treasury, but the system itself benefits the banking sector by ensuring infinite demand for government debt. The government never runs out of buyers. Check. Add Warburg's technique from World War I. Finance multiple sides, profit regardless of outcome. Today's global banks do this everywhere. They finance US debt and Chinese debt, European debt and emerging market debt, corporate debt and sovereign debt. They don't care who wins geopolitical conflicts or economic competitions. They profit from all sides. Goldman Sachs, JP Morgan, Citigroup all have operations in dozens of countries. They underwrite bonds for competing governments. When tensions rise, when conflicts escalate, both sides borrow more, and the banks profit from all of it. Check. Add Rockefeller's method from the 1,930 seconds. Use policy to create crises, buy assets cheap, profit from the government. The response. In 2008, the big banks caused the crisis through reckless lending and derivatives trading. The housing market crashed. Millions lost their homes. The government issued trillions in debt to bail out the banks and stimulate the economy. The banks bought up foreclosed properties at depression prices through their real estate divisions. They purchased the government bonds issued to fund the bailouts. They profited 3 times, from creating the crisis, from the bailout, and from buying distressed assets. This is the Rockefeller playbook, executed perfectly. Check. Add Goldman's innovation from 2008, become too big to fail. The largest banks in America now control over $10 trillion in assets. They're primary dealers in treasury bonds. They're counterparties to derivatives worth hundreds of trillions notionally. If any of them fail, the entire financial system collapses. So the government must bail them out, must protect them, must ensure they remain profitable. Because if they go down, the government's ability to borrow goes down with them. This makes them untouchable. They can take massive risks, pay themselves enormous bonuses, and if something goes wrong, they get rescued. The profits are private, the losses are socialized, and the debt issued to cover those losses becomes another profit stream. Check. The result of these 5 innovations layered together. $38 trillion in U.S. debt. And that number is accelerating. In 2000, U.S. debt was $5.6 trillion. In 2008, it was $10 trillion. In 2020, it was $27 trillion. In 2024, it's $38 trillion. That's a $14 trillion increase in just 4 years. The interest on this debt is $1.1 trillion annually now. That's more than the defense budget, more than Medicare. And it's paid to bondholders, pension funds, insurance companies, foreign governments, and banks. The banks descended from the 5 families: JP Morgan Chase, Citigroup, Bank of America, Goldman Sachs. They hold billions in treasuries, directly. They manage trillions more through asset management arms. BlackRock, the world's largest asset manager, manages $10 trillion. Much of that is in bonds, government bonds. Larry Fink, BlackRock's CEO, is the modern equivalent of JP Morgan or Nathan Rothschild. He doesn't produce anything, doesn't build anything. He manages money, and a huge portion of that money flows from government debt. Check. But it's not just America. Japan owes $14 trillion, 260% of GDP. Their central bank, the Bank of Japan, owns nearly half of all Japanese government bonds. They've created yen out of nothing to buy their government's debt. The interest payments flow from Japanese taxpayers to the Bank of Japan, which is technically independent but functionally supports Japanese banks and financial institutions. Europe owes $17 trillion collectively. The European Central Bank has bought trillions in European government bonds through quantitative easing programs. Again, money created from nothing, used to buy government debt, interest paid by European taxpayers. China officially owes $13 trillion, but if you include local government debt and state-owned enterprises, the real number is over $40 trillion. Chinese banks, which are state-controlled but operate like profit-seeking institutions, hold most of this debt. The pattern is global. Every developed nation and most developing nations follow the same model. Borrow continuously, never repay principal, pay interest from taxes, and ensure that private financial institutions profit from the arrangement. Check. And here's the acceleration. Since 2020, global debt increased by $50 trillion. $50 trillion in 4 years. The pandemic was used as justification. Governments borrowed to fund lockdowns, stimulus payments, vaccine purchases. But here's what happened to that money. It flowed through the banking system. Governments issued bonds. Central banks and private banks bought them. The money was distributed to citizens and businesses who deposited it in banks. The banks used those deposits to buy more government bonds and other assets. The wealthy, who own most financial assets, saw their wealth increase by trillions as bond and stock prices rose. Meanwhile, the debt that funded this wealth transfer sits on government balance sheets, and taxpayers will service it for decades. This is the debt profit pattern at scale. Create a crisis, convince governments to borrow trillions, ensure the money flows through the financial system, and capture the wealth while distributing the debt burden to the public. The five families pioneered this over 200 years. Their descendants, the modern banking institutions, have perfected it, and they're executing it right now. But here's the final piece that makes the trap inescapable. The debt can never be repaid. Not because governments don't want to, but because repaying it would destroy the economy. U.S. government debt isn't just debt, it's the foundation of the money supply. Treasury bonds are used as collateral for loans throughout the financial system. Banks use them to meet reserve requirements. Pension funds use them to generate returns. Foreign governments use them to back their own currencies. If the U.S. paid off its $38 trillion in debt, if it stopped issuing bonds, those bonds would disappear from the system. Banks would lose their collateral, pension funds would lose their safe assets, the money supply would contract by trillions. The result: deflation, depression, economic collapse worse than anything in history. So the debt can't be paid off, it can only grow. And as it grows, the interest payments grow. The $1.1 trillion paid annually now will become $1.5 trillion, then $2 trillion, then more. And every dollar of that interest flows from taxpayers to bondholders, the institutions descended from the five banking families. This is the machine they built. A machine where government debt is infinite, where interest payments are permanent, where the debt can never be eliminated without collapsing the economy, and where the profits flow eternally to the financial class that designed the system. The Rothschilds showed how to make debt international and inescapable. Morgan showed how to make it unlimited through central bank money creation. The Warburgs showed how to profit from all sides of every conflict. The Rockefellers showed how to use crises to extract maximum wealth. Goldman Sachs showed how to become untouchable through systemic importance. 5 families, 5 innovations, 250 years. And the result is $315 trillion in global debt, all of it paying interest to the modern descendants of those banking dynasties. Not because they built anything, not because they served anyone, but because they designed a system that forces governments to borrow forever and ensures they profit from every dollar issued. 5 families built the debt trap over 250 years. They didn't conspire in a single meeting. They didn't coordinate across centuries. But each one learned from the previous generation. Each crisis refined the technique. Each innovation made the system more inescapable. And now every government on Earth is caught inside it. The Rothschilds made debt international in 1815. The Morgans made it infinite in 1913. The Warburgs globalized it during World War I. The Rockefellers weaponized it during the Depression. Goldman Sachs made themselves indispensable in 2008. Each believed they were just running a business, just making smart financial decisions. But the cumulative effect was a global debt trap that enriches financial institutions while impoverishing everyone else. And here's what should keep you awake at night. They're still doing it. The same banks, the descendants of these families, are still engineering crises, still profiting from bailouts, still collecting interest on debt that will never be repaid. We're not at the beginning of this pattern. We're not even in the middle. We're near the end. Because the math says this is unsustainable. You cannot pay $1.1 trillion in annual interest when your revenue is $4.5 trillion and your spending is $6.3 trillion. The gap has to be filled with more borrowing, which means more interest, which means an even bigger gap. It's exponential. At some point, probably within the next 10 to 20 years, one of two things happens. Either governments openly default, admit they can't pay, restructure the debt, and watch the global financial system collapse. Or they inflate away the debt, print so much money that the nominal debt becomes meaningless, but the purchasing power of everyone's savings evaporates. Either way, the people holding real assets, the ones who own land, resources, productive businesses, they survive. The ones holding currency and bonds, normal people with savings accounts and retirement funds, they get destroyed. And the banking families and their institutional descendants, they already know this is coming. They're already positioned. They own the real assets. They've been using the last 15 years to buy up real estate, farmland, natural resources, infrastructure. When the debt collapses, when the currencies fail, they'll own the physical world, and everyone else will owe them rent. This isn't speculation. This is pattern recognition. This is what the Rothschilds did after Napoleonic Wars. This is what the Rockefellers did during the Depression. This is what Goldman Sachs did in 2008. They create the crisis, or wait for it, profit from the government response, and then buy up assets while everyone else is panicking. The next crisis will be the biggest, because the debt is the biggest. And when it comes to the modern versions of these five families, the Jamie Dimons and Larry Finks and David Solomons running JP Morgan and BlackRock and Goldman Sachs, they'll do exactly what their predecessors did. Collect bailouts with one hand, buy assets with the other, and emerge richer than before, while everyone else pays the price. 5 families, 7 major crises, 30 wars, 250 years. And the pattern is so clear, so documented, so obvious once you see it, that you'll never look at government debt the same way again. The $38 trillion America owes isn't a mistake. It's not a problem to solve. It's a profit center for the institutions descended from these banking families. And every dollar of interest you pay in taxes, every dollar the government borrows to cover deficits, every dollar printed by the Federal Reserve, it flows to them. By design. Just like Nathan Rothschild designed in 1815, just like J.P. Morgan designed in 1913, just like Paul Warburg designed during World War I, just like the Rockefellers designed in the 1930 seconds, just like Goldman Sachs designed in 2008. The pattern repeats because it works. And it works because most people never see it, never understand it, never realize that they're inside the machine, paying rent to people who produce nothing, build nothing, serve nothing, but own everything. If this opened your eyes to how the debt profit pattern actually works, if you finally understand that $315 trillion in global debt isn't an accident but a business model, subscribe, because when the next crisis hits, and it will, you'll want to understand who profits and how. The answers aren't in economics textbooks. They're in the history of these 5 families, in the crises they engineered, in the bailouts they collected, in the assets they bought while everyone else was losing everything. They're not going to teach you this in school. They're going to teach you that debt is necessary, that banks serve society, that financial innovation helps everyone. But the Rothschilds, the Morgans, the Warburgs, the Rockefellers, and Goldman Sachs knew better. They knew that debt isn't a tool for building, it's a tool for extraction. And the $315 trillion we owe is proof that their system worked perfectly.